Microsoft stock is experiencing notable volatility this week, with the current live intraday price trading at $430.30 per share, marking a decline of 2.49% in recent hours. This immediate pullback reflects a sharp intraday swing from the session's opening levels and comes on the heels of a broader multi-day fluctuation, where the equity managed to test areas near the mid-440s before giving back gains. While standard market participants look at this daily price action and assume it is just another routine tech sector pullback, the true story unfolding beneath the surface is a high-stakes institutional battle over capital allocation. The sudden drop today is heavily tied to a reaction following a newly signed executive order from the federal government that introduces a voluntary review program for high-performance intelligence models. Though the program is promoted as a partnership for evaluating security, the market is misinterpreting the move as an early sign of regulatory friction, sparking quick liquidations from short-term traders. This is where the gap between expectation and reality widens significantly, because what the crowd views as an impending compliance bottleneck is actually setting the stage for major enterprises to consolidate their lead. The mainstream consensus around Microsoft stock right now is that its immense size has turned it into a sluggish middle child of the tech space, trapped between the physical hardware dominance of NVIDIA stock and nimble enterprise application players. Investors look at the massive capital expenditure bills attached to cloud data centers and worry that the software giant is spending billions just to maintain its current position, without a clear timeline for outsized returns. However, the reality of the situation is that Microsoft is quietly executing a major strategic pivot toward complete self-sufficiency, moving aggressively away from its historic dependence on external chip design firms. At the recent Build conference in San Francisco, the unveiling of their proprietary Maya 200 silicon and custom AI models showed that they are actively building a cost counterattack designed to protect their operating margins from escalating third-party licensing fees. When you analyze this development, the narrative shifts from an expensive defensive posture to an offensive infrastructure play that could structurally alter the company's long-term unit economics. This stark divergence between what the public believes and what the operational data shows is precisely why the stock is experiencing such violent intraday repricing. Looking closely at the immediate price action and trading volumes, we can see that institutional accumulation had picked up drastically earlier in the week, with trading volumes swelling well beyond the 30-day average of 38 million shares. This surge was characterized by major block trades as funds repositioned ahead of the Build event, pushing the equity past key technical thresholds like the 50-day and 200-day moving averages. Yet, despite that initial burst of bullish momentum, the stock has encountered fierce resistance around the $440 mark. This resistance is driven by a complex mix of macroeconomic pressures, including persistent inflation concerns that keep Treasury yields elevated and put downward pressure on premium software valuations. Large-scale institutions are using online investment platforms and individual brokerage accounts to execute sophisticated hedging strategies, creating a highly fragmented trading environment where every headline causes rapid shifts in sentiment. For individual investors utilizing online investing tools or looking for investment help through automated systems like Schwab Intelligent Portfolios, this choppy tape can look incredibly discouraging, but it represents a classic technical consolidation phase. If we examine how this volatility is playing out across major retail and institutional platforms, the data points to a massive tug-of-war. Active traders on the Robinhood app and the Robinhood stock trading platform have been heavily focused on short-term call options, betting on a quick recovery back toward the prior 52-week high of $555.45. At the same time, long-term capital managed through traditional platforms like Fidelity Investments and Fidelity Brokerage accounts is showing a more measured approach, focusing on the underlying cash flows rather than the daily noise. The recent data from Fidelity Mutual Funds and Fidelity Wealth Management indicates that large-scale portfolio managers are viewing this pullback below the $440 level as an accumulation zone, supported by the upcoming dividend distribution of 91 cents per share. This contrast in behavior between retail momentum on the Robinhood app and institutional anchoring across Fidelity trading platform systems highlights the fundamental tension in the market right now. People are treating the software sector as if it is on the verge of a structural collapse, a fear often discussed across popular investing sites. Yet Microsoft's actual core revenue metrics continue to expand at a double-digit clip. Let us pause for a moment to look at the broader landscape of how people are managing their portfolios during this tech shakeout. Comment below how many shares of Microsoft stock you currently hold in your personal portfolio, and let me know if you are using automated platforms or managing it entirely yourself. Looking at the competitive dynamics, platforms like SoFi Invest and the SoFi trading platform have seen a massive uptick in retail flows toward individual brokerage options as self-investing becomes more prominent among younger professionals. Many of these investors are trying to decide whether to park their capital in broad tech index funds or concentrated positions in individual equities like Apple stock or Tesla stock. What makes Microsoft unique in this environment is that it lacks the high-intensity consumer retail hype of a Tesla stock, but it possesses an enterprise lock-ins that traditional consumer brands can only dream of. When an enterprise integrates its workflows into the cloud ecosystem, the switching costs become prohibitively expensive, creating a highly predictable recurring revenue stream that acts as a natural buffer during macroeconomic downturns. To truly understand why the current market expectation is disconnected from reality, we have to look back at the company's foundational business model and its historical performance. For decades, Microsoft operated on a traditional software licensing framework, where businesses paid flat fees for localized software installations. The transition to a cloud-based, subscription-oriented structure over the past decade completely redefined the company's financial profile, turning highly cyclical software sales into a continuous stream of predictable capital. Their core cloud platform, Azure, has consistently delivered impressive year-over-year growth, frequently beating consensus estimates and serving as the primary engine of value creation. Older financial reports from recent quarters confirm this strength, with fiscal third quarter revenue hitting $82.9 billion, an 18% increase year-over-year, alongside a net profit margin hovering around 38%. These are staggering numbers for a corporation with a market cap sitting above $3 trillion, demonstrating that despite its massive scale, the organization can still innovate and capture market share effectively. Despite these exceptional fundamentals, the near-term trading environment remains incredibly sensitive to headline risks and sector rotation. On institutional execution venues like the Interactive Brokers platform and through Interactive Brokers stock trading accounts, we are seeing high-volume algorithmic selling whenever tech sector momentum stalls. The sophisticated traders using Interactive Brokers trading systems are highly attuned to the cost of capital, and with interest rates remaining stickier than expected, they are demanding higher risk premiums for companies trading at elevated price-to-earnings multiples. Microsoft currently trades at a forward price-to-earnings ratio of roughly 25 times, which is significantly lower than some of its hypergrowth peers like Nvidia stock, yet still represents a premium relative to the broader software sector. This valuation premium is the exact point of contention where the tension between expectation and reality manifests. The bears argue that the valuation is unsustainable if cloud growth decelerates even slightly, while the bulls contend that the premium is entirely justified because Microsoft is the only mega-cap tech giant successfully turning infrastructure investments into immediate enterprise software revenue. As we look toward the future, several distinct scenarios could play out over the coming quarters. The most bullish pathway relies on the rapid adoption of their internal silicon architecture. If the Maya 200 chips can successfully offset a meaningful portion of their capital expenditure requirements, Microsoft will be able to expand its cloud margins at a time when its competitors are forcing customers to pay soaring hardware premiums. This would allow them to offer highly competitive pricing on enterprise applications through active investing initiatives, capturing dominant market share across both public and private sectors. Conversely, the primary risk scenario involves a prolonged regulatory slowdown stemming from the new voluntary government review programs or a broader deceleration in enterprise IT spending. If large corporations begin to scale back their digital transformation budgets due to macroeconomic strain, the massive capital investments Microsoft has made into new data centers could temporarily become a drag on free cash flow, forcing a deeper technical retracement on major investing sites and trading applications. Evaluating the structural setup of the business alongside these shifting market dynamics reveals that the underlying narrative is far more resilient than the current daily price decline suggests. While short-term option traders on platforms like SoFi Invest or individual brokerage accounts fret over the immediate 4% swings, the long-term capital allocations occurring within institutional spaces tell a story of deep structural support. The company's ability to consistently beat earnings expectations, paired with its 23 consecutive years of dividend increases, provides a financial baseline that few other tech companies can match. Investors who approach the market with a long-term perspective, utilizing robust platforms like Interactive Brokers fees models or Fidelity IRAs to build disciplined positions, are recognizing that the gap between market panic and actual corporate execution is presenting a classic valuation mismatch. The noise surrounding new regulatory review frameworks will likely pass as compliance protocols are standardized, leaving the core infrastructure advantages completely intact. In summary, the central insights driving Microsoft stock today revolve around the profound contrast between short-term market anxiety and robust operational execution. The public expectation is focused heavily on regulatory headwinds, high infrastructure costs, and a perceived loss of agility relative to specialized competitors. The reality, however, is a company maintaining an 18% revenue growth rate at a multi-trillion-dollar scale, actively de-risking its supply chain through custom chip development and maintaining an enterprise ecosystem that is deeply embedded in the global economy. Today's intraday decline to $430.30 reflects the immediate tension of a market grappling with macroeconomic uncertainty and policy shifts, but it does little to erode the fundamental earnings power supporting the enterprise. As the dust settles from this week's technical corrections and policy announcements, the structural divergence between subjective market narrative and objective financial performance will continue to dictate the ultimate trajectory of this tech giant.